Welcome back to another episode of With Sonar. It's Luke, it's Tony. We've got a great episode for you today. We're gonna be looking at some new data sets today. We've got a lot of new earnings today. Caused a little bit of controversy in the social media world. With a very select group of people, but we're gonna get to that here in a little bit. But just a little highlight of what we're talking about today. Okay, we've got rising truckload volumes, called that. We've got rising tender rejections, called that. We've got falling retailers, Tony called that. And we've got falling CPG company performances, Tony called that one. So yeah.
I don't think the volume one is that. I mean, it's a little surprising, but not really when you look at ocean data, right?
Yeah.
But the problem is,
that's what I said to look at.
It started to decline, right? So I think that's part of it, is like it's showing signs like almost a pull forward of freight. So we'll see. I mean, the question is right now is one thing. What is it 2-3 months from now? That's the better question.
That's the question, right? You know, we're seeing a little bit of life in demand. It's had zero impact on rates. Tender rejections, it's had a tiny impact on tender. Technically, tender rejections are up over 50% from their bottom this year, but they were also at as close to zero as it's ever been. So, whatever. Not all that exciting. You know, if you go from earning $1 a day to $1.50 a day, yeah, you increased by 50%, but it's not a big impact. But nonetheless, got to start somewhere.
The issue is rates haven't moved and diesel prices are way higher than where they were just a few weeks ago.
Which if you're in the contract market, you're probably fine. But in the spot market,
I mean, even in the contract market, you're still kind of getting squeezed. I mean,
not as much, though.
Yeah, it depends, right? Because if you think...
Might be a wash.
Fuel surcharge largely is... It depends on if you have a fuel contract, right?
Right, if you're buying
rack, you're okay. If you're not, and you're just getting the 3-cent discount at the pump or whatever by signing up for the fuel rewards, you might get squeezed on a weekly basis just because the rate at which the average price at a truck stop has gone up has been faster than I shouldn't say faster. The DOE that fuel surcharges are typically set on a Monday night, right?
Yeah.
It comes out Monday night. It's once a week. We've seen, even if you see a 22-cent increase in a week, or 10-cent increase, or whatever the increase is, if the daily price between that continues to go up,
you're always a little behind.
You're behind. So it does generate a little bit of a squeeze. It's not that much. It's not as much as if you're operating in the spot market and not getting any fuel surcharge, because if you're in that, you're really getting squeezed from this.
Yeah, I mean, basically, like, rates have been flat for the last, 3-4 months in the spot market?
Largely.
From a dollar perspective, but when you think about from a margin perspective with how much fuel is going up, it's really actually gone down by quite a bit.
Yeah, because it's effectively...
Or it's eaten into their margins.
Oh, yeah, and they're already thin. I mean, you think...
Yeah, or not.
You look at some... Yeah, exactly. I mean, they may be operating 100-plus OR, and they might have had a cash reserve, and that will be wiped out rather quickly. And I think that's the difference, is you were seeing fuel decline and rates were holding steady. Now you're seeing rates hold steady and fuel rise. So revenue effective. Granted, you're seeing volume a little better, so maybe you're playing in the market a little more, right? You're moving maybe. And the caveat is spot market volume is still depressed, right? Because there's just not as much freight flowing through to the spot market. You're still, 3.7%?
Yeah, 3.7 as of today. Let's go ahead and pull up truckload volumes here just for folks to be able to see. So truckload volumes hit a year-to-date high. They've finally rematched those highs from early June, kind of right after Memorial Day, that little spike, which, not a lot there. So just continued to pump through July and August, very seasonally abnormal. And to your point, Tony, we're not going anywhere near the high levels that we had in 2020, 2021, even the highs in the early 2022 parts. We're not going anywhere near those. I think we all know that and agree that. But this does look like fairly healthy growth, long term. If you took out COVID, this actually looks pretty decent.
Yeah, I mean, this is where you would expect to be, right? I mean, ideally you have a growing economy.
The market looks healthy. If you take out those big spikes in COVID that we had, this looks like you said, representing a healthy economy. What you had talked about in the Daily Watch the other week, which was the consumers have actually shifted more towards physical goods over the last handful of years.
Yeah, I mean, and that was pre-pandemic, right?
Yeah.
You had gone from like 33%
in 2014?
36%, right?
Yeah.
Pre-COVID. So, I mean,
now we're
talking,
at 39?
Yeah, we're at 39. So,
I know we peaked at 42, but again, that's COVID.
Yeah, so, I mean, overall, what you're seeing is kind of this reversion to a trend line that had been set previously. So, yes, you're seeing more spending on goods, and I think you also factor in how much we stimulated the economy and how much now it's not stimulus in the form of the consumer, it's stimulus in terms of government spending through bills like the CHIPS Act and the Inflation Reduction Act and things like that help drive freight demand too, right? We're not 100% goods economy. Like we can see that based on just that spending, the 30, but that's only part of it, right? The consumer is only one part of the overall economy. The government spends a lot of money on things that don't impact the consumer in a way that is just, like the stimulus measures that we experienced throughout the pandemic, right? They stimulate the economy in other ways.
Correct. Now, I think here, when we look at this volume chart, it's, to your point, it's going to be really key where it heads ultimately as we finish out this quarter. What does September and October look like? Those will be really telling signs of this is going to continue. But nonetheless, for those out here, this is a good sign that demand is kind of inching back up. That's a good sign, right? If nothing else, it's not flat and it's not falling. It's inching up.
Yeah.
There's still obviously too much capacity, and that's why rates have moved up. If we flip over to tender rejections really quickly, we're going to see this. You've seen a tiny bump in tender rejections. This is the year-to-date chart here for tender rejections, still down massively year-to-date, down egregiously from where we were a year and a half ago. But we are retesting kind of those highs from February and even, again, going into 4th of July weekend.
Yeah.
And that's a good sign. I think if we hit that 5% range, I'll raise my eyebrows a little bit. I think by that point, we're going to if we get to that level, we'll see spot rates come up. Not a lot, but a little.
I think, that's a good call out. You're also seeing signs of life around holidays, right? I mean, if you look back, look at Memorial Day. Like, there's no movement, really, right? We came off of where we were at the bottom of May, but, we were effectively where we were in April.
Right.
Then you look at 4th of July, leading to the 4th of July, basically the highest level we saw all year, because if you take out the 2 weeks after the holiday, which are naturally higher as capacity takes off for holiday and then they come back, especially around Christmas and New Year's, it takes a little time for rejections and capacity to get back into locations that it's supposed to be. What you're seeing is now we are 2 weeks away from Labor Day weekend. You're starting to see the movement you would like to see associated with holidays. Back in 2019, Zach Strickland and I mentioned this, I guess, last week. You look at the holidays, and while rejection rates were so low, you saw pulses around the holidays and they amplified throughout the back half of the year, kind of setting up 2020 to be one of those years where maybe it's not going to do what COVID did to the market, but you saw signs of the market deterioration when you see a company like Celadon go under in the back half of the year. But, you're ultimately kind of setting up 2020, especially the back half of 2020, to be better than 2019 obviously was. What you're seeing is very similar pulses, right, in the market that, hey, maybe things are set to improve. We still have too much capacity, evident by the 3.7% rejection rate.
Yeah.
But the fact is, there's a little more reactivity to holidays, right, that would have caused capacity disruption. Those disruptions, or the appearance of the disruption, is getting larger than it was earlier this year.
Yeah,
really.
It's a good sign. Long way to go, but nothing.
Yeah.
But it's definitely a good sign, if nothing else. Now, I do want to transition. We're going to talk about a new data set here, and this is one that myself, a few others are talking about online. So this is very new. It's very early. This is like the most alpha stage you can be in like a data set. Okay, so just understand that. However, it's already proven to be immensely impactful and incredibly far upstream in measuring economic activity. And it's a data set we're going to be talking about. It's our truckload visit data set. So this is going to measure, there it is, it's right on the screen now in front of you. This measures the number of trucks visiting a particular business. So this is tracking the telematics or ELDs on trucks, the physical location. So in this particular case, we're using Target as an example. They reported earnings the other day. They revised sales guidance much lower for the rest of the year. They did have a nice earnings per share beat, so their stock wasn't too beat up. But, it's, nonetheless, this is something that in Q1 of this year, it called out an incredible signal that truck visits to their facilities, distribution centers, warehouses, which will help account for retail sales as well as online sales, dropped an astounding 34%. And it wouldn't be until late May when this type of information would get out that, Target was having a hard time with sales, that their stock would drop further. And their stock dropped about 18% in the back half of May. So a nice leading indicator there, very far upstream. Obviously, this isn't something you're going to base your entire trading strategy around, but it is a great signal.
Yes, the key in this, right? The market awarded an earnings beat, but you dig into how did they beat earnings? They reduced cost.
Yes.
Right? Cost of sales was down 11.6%. It was an 11.6% improvement year over year. Guess what? Like, that is how your top line revenue was down 4.9%.
Year over year?
Year over year in the second quarter, right?
Yeah.
Because they're on the fiscal quarter, so a little different. But what you're seeing, so revenue's down 4.9%, which is effectively what this shows, right? Slowing demand at their stores.
Correct.
The thing that Target got right was they got cost under control.
Yes.
And that is, it's not, I was gonna say it's arguably as important, right, to growing the top line as it's probably more important at a company or a size of a company of Target, right? I mean, you're talking $24 billion in revenue in a quarter.
Yeah. So they were smart, right? They saw that, hey, listen, the stimulus money effectively, let's be honest, that's what a lot of this was. Yeah. Right? The stimulus money is dried up. Sales are going to take a hit. We know that. Okay, so let's do what we can. We cut costs. Yep. So from a business perspective, they're running very smooth.
Yeah.
And Wall Street rewarded them on today's earnings as a result.
Yeah.
Now, I say rewarded them, their stock's still down 15% this year.
Yeah.
Kind of, while the S&P 500 is up over 15%. So there's still some, I wouldn't say they're being totally rewarded, but, there is obviously some, hey, you're doing the right things.
Yeah, exactly. I mean,
in a tough environment.
Yeah. And I mean, I think, again, we go in and you look at this chart and you see the declines in visits. I mean, it's just, take the fourth quarter, right, or the back half of last year out of it, because, I mean, you're still dealing with an inventory problem, right? And
well, we were seeing, if you go back in this data, it's not on the screen, we've been seeing a decline in in truck visits to Target for probably the last 20, 22 months.
Which is right in line with when they would have realized that they had an inventory problem.
And we saw that they announced in May of 2022 that they were, or April or May of 2022, that they were having to decline a lot of things. So, or they were revising inventory down.
The other factor that they have is they've cleared inventory too, right? They've done a good job of clearing that inventory, right? So that's one of them, right? They're not holding that inventory. The inventory is not on a cost of goods sold. Inventory factors into that, an inventory cost. If you reduce your inventory, it helps boost that number or improve that number. So I think overall, I look at it, it shouldn't be a surprise. But I mean, if you're paying attention to that upstream, right, you see that the decline. And it's not even the decline sequentially. Put it in year over year terms, I think is more impactful. Yeah. And you made a good point. When you factor it in, a company like Target or a Walmart or a Costco or any of these companies, inflation boosts their sales numbers, right? Or it can to it. Because if you think about volume or how they generate revenue, right? It's sales of goods. If the price of the good is higher, but volume is slightly down, well, the revenue number can be higher, right? If they can offset, right? By higher prices offset the lower volumes. very similar to what CPG companies are doing right now, right? You hear Coke, their price mix or volume mix was like flat to down, but prices are higher, revenue's higher, margins improve. The interesting part is you see the decline in truck visits. That's actual volume. It doesn't have anything to do with the dollar signs.
Yeah, I mean, we've talked about this, right? I mean, you could see a decline in actual sales volumes, but if inflation makes up for that, or from a dollar perspective, it could look like sales are growing.
Yeah.
Right? We've talked about that. Also, there's other ways to generate income beyond just selling physical products, which is a perfect example is somebody like, we track this same data set for Amazon. It's going to give you great insight into their retail sales or e-commerce sales. It's not going to tell you anything about their subscription sales or AWS, right? Or their advertising numbers now that they do a lot of. It's not going to tell you anything about that. So it's important to understand kind of what we're looking at here, what part of the business, which is why, like, whenever you're talking about alternative data that a lot of that Wall Street uses, it's one part of their equation, and they tend to have tons of different data sets that go into this. But this is a great one that shows tons of early movement for economic activity, which I love.
And
that's what it is.
The key in this one is it useful for somebody in the market or in transportation as a whole? Probably not.
I'm skeptical.
Yeah, I mean, how much do you need to know?
In its current stage, probably not.
Yeah, it's more useful on the financial side to kind of gauge where the market's going or where the market has, ultimately where the market's been.
Yeah.
But the thing is, it's like if you don't know, or because you have to remember, those goods don't move immediately. Right? No. It's not an instant, hey, it's in here and now it's going out the door. Like, there's a lag time in this, right? So if you would have seen this decline 3 to 6 months ago, and now it's showing up in the data,
there it is,
by their earnings, right? Which is all you're really going to get access to because that's what they have to report it. But the factor in this, and the interesting part that goes in with this, is you would have seen it 6 months ago. What is the stock market trying to do? Gauge what's happening 3 to 6 months from now. Right? And that's why if you would have had this in March, you might have seen this decline. You might have been able to get ahead of that 18% drop. You might have known, hey, this thing, there might be some slowdown coming, right? There might be disappointment on the horizon, lower guidance, things like that. They can make their own decisions, but if you see the data, it's hard to deny what was happening in the moment. And again, comparing what happened in the fourth quarter to what was happening. So really, call it even October, November, December, and compare that to January, February, March, you're obviously going to see a sequential decline. Like,
true,
holiday.
But we're also, like, in that last chart that we were looking at an average for
the last 6 months.
Last 6 months of 2022 compared to just Q1 of 22. So technically, if you look at that chart, it's 1 year. So really, we've actually declined further year over year. It was down close to probably 40% year over year in terms of volume, truck visit volume.
Yeah, and again, that goes into you're not going to see a 40% decline in sales.
No.
Right? Inflation, pricing, things like that.
Right. They had excess inventory. Also, like you said, inventories.
It's not going to happen, but it might lead to hey, they're expecting a slowdown, or things are slowing down.
Correct.
Kind of, again, way upstream of where you're going to see it actually happen.
So the other thing I think too that we also that we've been talking about, and this is something I posted about the other day, is we're seeing a lot of smaller, or even some large CPG companies declare bankruptcy, and I think we're going to continue to see more about this as well. So like one that I've been focused on is Beyond Meat. I don't know if they're going to go under or not. Time will tell. But Beyond Meat is one of those companies. They had an almost $20 billion market cap at one point, and now I think they're around $1 billion, give or take, maybe just over. I mean, their stock has fallen immensely, and a lot of that is due to a lot of their sales have just evaporated. It sounds like when you think about CPG goods, right? When you go to the store, right? A lot of these companies, Beyond Meat's just one of them. Bang Energy is another one that declared bankruptcy. I think Monster came in and acquired them, right? So these premium priced products that maybe have a good social cause, whatever ones you align with, but whether you like the cause or not, I think what we're seeing is at the end of the day, consumers, when budgets get tight, consumers are making those decisions to buy lower cost items.
Yeah, and you have to you see the stock price there from Beyond Meat. I mean, it's just
that's probably, honestly, that's a little unfair of me to put that up there, but I did it anyway because, well, I run the show.
But again, it's one of those things. You look at their earnings, right? Their Q2. I mean, you're talking U.S. retail sales revenue from retail down 38.5% year over year. Food service down 45.5% year over year. I mean, you're talking a total U.S. net revenue down 40% year over year. You're hoping consumer behavior's changing, and it's just not, right? You're trying to shift consumers. Essentially, in this case, you're trying to shift consumers' taste buds from a real meat product to an artificial meat product,
which is already expensive to have to educate people on and do a lot of the research on and market it.
Yeah.
You're constantly having to, you are in a new space trying to acquire new customers.
Constantly.
And that is very expensive to do.
Especially right now, right? When a consumer is cost conscious about what they're doing.
Right.
And I think there's a quote from going back to Target, and I think it's a great quote in reference to what we're talking about here. It says, from their CEO, Brian Cornell, he says, as we look at the consumer landscape today, we recognize the consumer is still challenged by the levels of inflation that they're seeing in food and beverage and household essentials. It's absorbing a much bigger portion of their budget. Guess what? You'll see trading down. Why would you spend $10 on a Beyond, hypothetical, why would you spend $10 on a Beyond Meat product versus say $5 on just the natural meat product, the same magnitude? I don't know the actual prices and the difference in the two, but ultimately, at some point, you're going to have to drive this premiumization and break away and offer discounts to stay in business. But I think what it shows is the cost to acquire consumers is extremely high, which it shouldn't be a surprise. You're having to change a behavior that they've been so used to for, years, right? So
they're plant-based. The Beyond Meat ground beef, I guess, is currently, it's about $5.31 a pound at Walmart, right? Which is, and I don't know if it's a total apples to apples comparison, but I'm doing my best here, versus if you look at
just the
typical ground beef, it depends on which one you get, $4.40 a pound to $6 a pound.
So what's interesting, it's cheaper than some of these.
Some of them. So it's priced about in the middle, actually.
Yeah.
Priced in the middle.
Effectively, all they have to do is change consumer behavior, which proves very difficult.
Very difficult. So it's not the cheap version, it's not the expensive one. But when you think about it, if you're comparing it to the cheapest, say just ground beef products, consumers know those and they know exactly what they're getting. So you're not competing with the cheapest products. Those are 15% cheaper. When you compare it to the most expensive ones, I think it's important to look at what are we comparing to. The most expensive beef products, those are the organic, those are the grass-feds, those are the Wagyu beef. And when you look at consumers, there's a very specific group of people who are going to buy those premium, real beef products, and everybody else is probably geared towards the cheap end.
You start trading down. And I think that's the key to remember, is that this trading down aspect is going to happen more and more as consumers' budgets have to tighten up. And I think one of the interesting parts is what happens come October 1st, right? Once those student loans, if you're a Sonar subscriber, there's another chart going in about student loans and consumer spending going in tomorrow in the Daily Watch. I think what's interesting
Which one?
It's Gen Z household income, sub $50,000 income. Those that have made payments have continued their spending habits, have actually, or higher, they've continued to spend more money than those that have deferred payments. But the interesting part is what happens when those deferred payments, that cohort that hasn't made payments, which might actually be a larger cohort, what happens when those payments come back? Because they haven't been spending as much already. Now you're going to factor in another payment. They may spend even less than what they were now or currently. And I think that's a concern moving forward.
Time will tell. We'll find out very soon. Stay tuned. Hope you guys enjoyed today's episode of Wish Sonar, and stay tuned for more FreightWaves content. Luke and Tony, have a good day.